Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about the dollar. If you like this kind of content, consider subscribing to the channel and leaving a like on the video. And as usual, nothing in this video is financial advice. So we still don't really have anything in the way of data, significant data coming out. Really it came out today or yesterday. We're really still in the midst of tariff drama. That is until tomorrow when we get some retail sales, which could be an indication of whether people are starting to pull back or pull back on spending. So we'll wait for that tomorrow. In the meantime, I would like to offer some perspective as Ego on Ratatouille once famously ordered. So, and what is that perspective? Well, different ways of perhaps interpreting the dollar. And really the DXY. What you have in front of you is purple is a DXY, the most common dollar index that it used, right? And blue, you have a trade-weighted US dollar. And what the main difference is that the DXY has a fixed weighting as opposed to the trade-weighted US dollar, which has a broader basket of currencies, and that usually gets updated at the end of each month. So it's kind of a more real time index, if you will. What you see really is that, and again, this is basically based off of trade relations, okay. And so what you see in front of you is that basically they've practically been the mirror image of one another. That is until June and really the summertime of 2024, when we started to see the first unwind of the carry trade and the first really risk off time, which didn't really last long because again we got the growth scare in with July's payrolls, and that lasted until mid-September, I would say, until we started to get economic data that was a bit more positive. And if you look, while the DXY is basically swept the previous lows of 2024, back here in 2023, and is effectively back at levels not seen since April 2022, the trade-weighted index is, yes, it still has seen a pullback, but it currently stands at the tops rather than the bottoms of 2024, 2023, and it currently is back at levels seen in August of 2022, all right, as opposed to back here, all right, back here. So that could also just shine a light on the fact that all of this, the dollar drama connected to the tariff drama is potentially a little overdone. Again, there is substance to it. I'm not discounting it all. But I think this is a valid tool to keep in mind, considering the fact that the DXY does have some inherent flaws, in my opinion. Because if you actually go and look, how is the DXY currently weighted? Around 58% is made up of the dollar, of the euro. All right. After that, you have the yen, following the pound at 12%, Canadian loonie at 9%, Swedish krona, and the Swiss franc. All right. Now, what is the problem with, potentially at least, what would be the problem with having the weighting distributed like this? Well, if you go and look at how the dollar behaves during times of, how the euro, for example, behaves in times of stress, This is 2008 and, the financial crisis. And if you look, I mean, it's kind of volatile, all right? And that can make the DXY sway in very, very dramatic fashions. Again, because you have it going down, you have the euro, losing steam, then it goes back up, then it goes back down, then it goes back up, and so on and so forth. You can also look at what happened during the 2000 recession. It goes up, go down, up, down, up, down. If you go and look at the 1990, probably a little bit less evident, but however, it's still kind of a theme. It's very volatile during times of stress. And if you add that to something like the yen, which is second at 13.6, and really the yen acts just like the Swiss franc as a risk-off currency, meaning that, if you sum up the yen and the franc with the euro, you have effectively 75% more or less of the dollar index be skewed by a volatile asset and two risk-off assets, which during, again, times of stress tend to see inflows and tend to see things that potentially we're seeing right now. The yen strengthens and it acts as a safe haven asset, all right? So I would keep that in mind whenever you read the headlines of the dollar's collapsing because of the DXYs going sub 100, and definitely this is something we've talked about before. But this is just a tool to keep in mind how, yes, we're seeing some historical things occur, of course, yes, messy historical things, that is. But at the same time, it always pays to keep a level head, at least until the price action allows us, or at least until, the headlines allow us to keep a level head. And that leads me to kind of my closing remarks on the dollar, because something I talked about last night and the previous days I've been hinting towards, is the fact that we have seen the wrong kind of correlation between the dollar and bonds. Excuse me, still working on my throat. Meaning that usually higher yields, something like the 30-year bond, treasury, higher yields and a lower dollar is usually something we see in the past only during times of stress. Well, mainly during times of stress. And the examples I've proposed is Bear Stearns and Lehman Brothers collapse right here. For example, when Lehman Brothers collapsed, we have a 40 basis point rise on the 30-year yield. And at the same time, if you go and look at what the DXY was doing during those very, very happy times, of course I'm being sarcastic, in 2008, September of 2008, the dollar actually declined from top to bottom about 4%, 4.5%. So again, yields up and dollar down is something, is a bit of an anomaly, is what I'm trying to say. Going back to more recent times, so far, we have seen the following correlation. Yields up, dollar up. You've seen this from basically the rate hiking cycle, basically kick off. You saw the dollar kick off, meaning yields went up and the dollar soared. And whenever you saw the dollar retrace, you can rest assured that you saw yields follow suit. Right, this would be right here in October of 2022. You see the yields go down, basically do nothing for the rest of the first half of the year. And that is exactly what you see. And as the summer approaches, you have dollar going up, top in October, sideways, top in October. And it's basically a mirror image of one another. However, given the fact that now we have seen something occur that usually doesn't happen outside of messy times, what follows what comes after, really, the question is, what comes after yields up, dollar down, like we've seen in recent weeks? And I've actually spoken about this yesterday. If you go back to 2008, take Lehman Brothers, for example. Lehman Brothers collapses, yields up, dollar down, the dollar keeps on going on its merry way. In fact, this move really started in June of 2008. And then if you go and look back in 2008, June of 2008 is really right here. All right. So again, the problem really isn't the fact that we've seen the dollar go sub 100, in my opinion. The problem is that we've seen the dollar go sub 100 and go lower at the same time when yields were going higher. And what usually comes after that is the dollar actually strengthening. Now, it doesn't have to mean tomorrow, it doesn't have to mean next week, but history shows, at least, well, as useful as history can be, that usually, if we have to follow the rule book, you get the dollar going back higher and actually seeing yields go lower, flipping the correlation that we've seen so far. So again, so far we've only seen two things. We've seen dollar up, yields up, dollar down, yields lower, right? And the perfect example of that is what we saw in the summertime of 2024. You saw the dollar go down, and at the same time you saw yields just, go downhill. Potentially, if we are to follow history, we could soon face a scenario where we see the dollar go up and yields go lower. But that, again, that is all hinging on the fact that on a lot of assumptions, really. I'm personally, as of Wednesday, when I woke up and I saw this huge candle right here, my first instinct was to say that was probably liquidation, forced liquidation. By whom? I don't know. For what? I have absolutely no idea. That was my first instinct. And again, that's one of the things you have to kind of bank on. And the rest is just, looking at the headlines and seeing if, we don't get any more crazy news, which, I wouldn't hold my breath on that, at least just yet. As far as today's price action is concerned, again, we're getting a taste of it today. We see dollar up, yields lower, and stocks really just having a snooze fest, across, small caps, triple Qs, and the S&P 500 not doing much at all. I think that today we're getting a taste of what could come next. But again, this is just, again, as the great Benjamin Kahn would say, dubious speculation. But again, if history is an indication, right here, and excuse me, I wouldn't be surprised if actually we see the dollar rise again. Potentially, if things were to follow things we saw like in 2008, possibly, could we get close to the 2022 highs? I don't know. I guess we'll just have to watch the price action and see how things evolve. So far, I think that today could be just a small taste of what is next. I'll leave it at that. if you like this kind of content, consider leaving a like and subscribing to the channel. And I'll see you next time. Bye.